Okay, so I'm going to go over the Chapter 3 problems assignment. This first problem is where you're going to be matching the description of the journal entry to the journal entry. Okay? And so they're either describing an adjusting entry or an entry related to an adjusting entry, right? Because we know in an adjusting entry, you're either debiting an expense account or crediting a revenue account. Okay, so here's this one, cash unearned revenue. That's not an adjusting entry, but it's related to unearned revenue or to an adjusting entry because unearned revenue needs to be adjusted at year end. Okay, so we can see, where is it? To record cash receipt of unearned revenue. That was G. Okay. And then here we can see one, depreciation expense, accumulated depreciation, right? This is an adjusting entry because you're debiting an expense. So that's A. So you're going to go through and you're going to choose which transaction description matches with the journal entry. Okay. Be careful with your check my work. I would do the whole thing before I used to check my work. Don't do just a couple because then you'll run out. You want to make sure you get them all. And then this next one is just recording journal entries. I should correct myself. It's recording adjusting journal entries. Okay, so we know you're going to go through, you look at the information, decide, are we dealing with a revenue or an expense? Okay, expense, that's your debit. And it could be either a revenue or an expense. It won't be both. If it's a revenue, that's your credit. You have to figure out the other half of your entry. Okay, and some of these you don't have to figure out the amount. Like for depreciation, the amount is given. However, for prepaid insurance, this one, they tell you that it had a $3,200 debit balance before adjusting. So that's your unadjusted balance. Okay, so at one point in time, you had paid for $3,200 of insurance ahead of time. They say they analyzed the prepaid insurance and showed that $1,200 was unexpired. Unexpired means it's still prepaid. And your problem might have different dollar amounts, okay? But the difference between the unadjusted balance and the unexpired amount at the end of the year is your expense. So that's the amount you're going to make your adjusting entry for. So there's a few of these that you're going to have to calculate the amount of the adjusting entry. Okay, and there's the summary cheat sheet at the end of the chapter is going to show the examples of the different adjusting entries. So that would be worth checking out to get the account names. But clearly you need to go through the chapter. All of the journal entries are discussed in Chapter 3. So you want to make sure that you have read the chapter. And again, my videos also talk about these adjusting entries. Okay. The next one is you're given adjusting entries and you have to say how the financial statements are affected. Okay, so every adjusting entry is either recording an expense or recording a revenue. So we know that an income statement is always going to be affected. Net income will be affected. Okay. So for example, in A, depreciation on the equipment is $6,200. So when we record depreciation expense, that makes expenses higher. That's going to make net income lower. Okay, and since it's $6,200 is going to be the amount of the adjusting entry, net income is going to go down by $6,200 when you make that adjusting entry. And since net income is changing, that means retained earnings is changing. So your total equity is going to change the same way net income changed, right? Because net income gets added to the beginning retained earnings balance to get the ending retained earnings balance. So this is also going to be decreasing by $6,200. Okay. And so if we think about the adjusting entry, debit depreciation expense affected net income and the total equity, the credit to accumulated depreciation is going to make accumulated depreciation higher, which makes the book value of our assets lower. So we're going to see our assets decreasing by 6,200. So that's the thought process. You have to identify what would be the adjusting entry for each of these, and then think about how the income statement and the statement of retained earnings and the balance sheet are affected. So this is the same thing that you're going to be doing in your discussion for this week, because I have each person by Thursday is posting about a different adjusting entry, and then by Sunday you're commenting about that adjusting entry and the effect on the financial statements. Okay, so that'll be a good practice with that. Oh, I don't want to check my work. Next one. Okay, so now we're going to do the 4 closing entries. All right, and so the closing entries in the textbook, you can go to Exhibit 3.16, and that shows all, there's a chart that shows what all of the journal entries are for the closing entries. Requirement 2 for this problem is doing a post-closing trial balance. And you can look in the textbook at Exhibit 3.18 for an example of a post-closing trial balance. So here's the adjusted trial balance. Okay. And we know we will have closed, right? We know we close revenue, expenses, and dividends. And we know retained earnings will be adjusted. Okay. So our assets, our liabilities, our common stock are all going to be the same on the post-closing trial balance as they were on the adjusted balance. And then our retained earnings balance is going to be changed by what you do to the retained earnings account in the closing entries. Okay. The next problem, problem 5, is again doing more closing entries. Okay. And so the tricky part for some of them is figuring out the amount, because again, you can see the chapter and get the account names. You can look at that cheat sheet, that summary cheat sheet at the end of the chapter. But for instance, this one here, it says on September 1st, they agreed to do 5 training courses for a client. You'll be given a dollar amount. It might not be that what I'm given here. They say 2 courses start immediately and finish before the end of the year. 3 courses, and maybe you might have a different number, will not begin until next year. So it's $2,400 per class, and then there's a number of classes. In this case, there's 5 classes, so $2,400 times 5. That's the $12,000 that the client paid in advance, right? So that was unearned revenue when the client paid in advance. By the end of the year, 2 of the courses had been completed. So here's the amount, take the amount per class times 2, that's the amount that's been earned. Okay, so our adjusting entry is it's going to come out of unearned revenue and it's going to be recorded as revenue. This next one, October 15th, they agreed to teach a class. Payment is due at the end of the class. So they haven't gotten the cash. We're going to get the cash next year. So it's a 4-month class, October, so it'll go to November, December, January, February. The end of the 4 months is going to be next year. That's when they have to pay. So they've earned a portion of it, okay, and they give you the amount. So we know that's how much that has been earned. But this is going to be an accrued revenue, not a deferred revenue in this case, because we're not getting the cash until next year. So there's not too many entries, but make sure you think them out. Okay. Okay, and then our last problem is doing a balance sheet. So in this chapter, actually you're doing an income statement, a statement of retained earnings, and a balance sheet. Okay, so the income statement and the statement of retained earnings is the same format as what we learned in chapter 1. Chapter 3, though, they teach you the classified balance sheet. And you can find the classified balance sheet in your textbook if you look at Exhibit 3.21. However, they don't have you put in the classifications, but you should know the classification. So under assets, you would have your current assets, those assets that you're going to use up within a year, and then your long-term, right? So right now we really just have property, plants, and equipment, but we'll talk about more long-term assets later. Under liabilities, you break it out between current liabilities. Those are the liabilities that are due within a year. And then long-term liabilities are the liabilities that are due after a year. Okay. But one thing that we didn't have in chapter 1 is here we've got the accumulated depreciation that we factor in. So you'll be listing the automobiles. No, I don't think that's the right place to put it. The automobiles. And your problem will have different number than mine, most likely. Drop in the amount. And then the accumulated depreciation goes right underneath it. And then the book value will be in the right column because it'll be added together with your other assets. And you'll do the same thing for the equipment and its accumulated depreciation. But other than that, the balance sheet is like the ones that we did in chapters 1 and 2.